This Friday was supposed to bring the latest jobs report out of the US, but thanks to the shutdown, that is no longer the case. Instead, we see the belated release of the September core PCE price index with the Federal Reserve's favored inflation gauge coming less than a week before they opt to keep rates steady or cut rates for the final time of 2025. So first and foremost, we can see here that essentially the market expectations point to a 0.2 monthly figure, 0.3 on the headline PCE, but generally we're all going to be following the core numbers. As you can see here, by and large, when we're looking at the wider figure in terms of the year-on-year figure, there's an expectation that's going to drop down to 2.8% for the core PCE figure. Now, that has very little to do with the monthly number. That's going to be a case of essentially a bigger figure in the past dropping out. So 0.2 has remained steady, as you can see here, same as last time, but we see a movement in the annual figure owing to those base effects coming into play. Certainly, if we were to see some downside in terms of that headline year-on-year figure, then that could provide a boost to markets as they start to think that price pressures are easing. Here's the outlook in terms of market expectations for the Federal Reserve, heavily geared towards a rate cut now, 87% chance. However, if you look into the beginning of next year, the next 3 meetings beyond that signal a pause, essentially. And so really that's why I've been sort of hammering on recently about the idea that maybe it doesn't really matter that much whether we cut in December or in January. But really the more important part of the picture is where rates end up. And right now markets are pricing rates to end up around the 3% mark. I think that's going to change. Now, we've heard from Donald Trump, who's essentially said that he's chosen who will be next in line to succeed Powell, taking over in May. And markets think it's Kevin Hassett. Now, ultimately, we're going to find that out in the new year. But that, I think, could provide a picture where that 3% sort of target, that terminal rate, so to speak, starts to shift, and that could see significant market movement as a result. But as you can see, 87% chance of a rate cut in December. Will we see increased expectations or decreased expectations off the back of this release? Well, bear in mind that the Federal Reserve has 2 sort of elements to consider here, the jobs market and the inflation picture, both of which are still potentially bottoming out, but we haven't seen a major surge in either. So it's a case of the Fed having to react to the risk of a surge in inflation and the risk of a surge in unemployment rather than a surge having taken place in either. You do see some indecision between some of the members within the Fed as a result of the 2 figures essentially starting to rise. And essentially, when you're looking at sort of weakness within the jobs market, you may not necessarily see it within the unemployment rate, but certainly we've seen some weakness elsewhere in the market. Here's the outlook in terms of overall inflation. So I've got headline CPI alongside core PCE, and you can see here that both are roughly around that 3% mark. We've seen a couple of relatively solid PCE figures of late, CPI figures of late, but the PCE's been largely under control. If we did see that 0.2 figure, that would point towards more of the same. The past 6 months really have been the period where we have seen price pressures under control, with that February reading representing the last really significant monthly surge in terms of price pressures. And that, of course, was prior to Donald Trump actually coming to power. So since Trump's come into the White House for the 2nd term, he's not actually sparked a major surge in terms of core PCE inflation. That's notable, of course, because he has enacted a number of policies that could have raised inflation expectations in particular pretty heavily. The 6-month annualized figure points towards a return to 2.5% in 6 months' time once we see some of those figures stripped out, notably the likes of the October, January, and February. And therefore, if we see 0.2 this time around, it really builds on that case that now it's 7 months where we've seen inflation under control and that the Federal Reserve can act if they deem necessary. As we can see here, that we've just recently seen ISM numbers coming out of the US. The ISM numbers are always important because they give you specific figures for the prices paid element. So you can see how sort of inflation is gathering pace or losing steam within the manufacturing sector, within the services sector. And notably, the services sector is the area where we've actually seen elevated inflation pressures remaining in play. And we've seen this sort of significant pullback in the manufacturing sector, probably as we've seen trade deals being struck. Nonetheless, as you can see here, we've got the core PCE, and we haven't necessarily seen a notable uptick. If you look back in the past, generally we see the ISM PMI figures, the prices paid elements, surge. If you look back in sort of 2019 into 2020, they surge ahead of time, and it took a fair bit of time for that inflation gauge to really start to gain momentum. So another way of looking at it is to take that PCE figure and provide an annualized number, which is going to make it a lot more reactive to near-term price pressures. So this means look at the last 3 months and span that out over the course of a year to show me exactly what the figure would look like. And you can see that, you know, we see some greater chop on this figure, which you would do because it's derived from a shorter time frame. But we don't really see that significant surge building at the moment. So as things stand, I would say the core PCE price index does signal the possibility for the Fed to act, and that's perhaps why markets are pointing towards those expectations being in play. A number of different areas to look at in terms of the jobs market, bearing in mind that we have had a relative blackout in terms of much of the data coming out of the US, and therefore people start looking for alternate methods essentially to be able to gauge exactly how the US economy is faring. Now, one of the measures that I wanted to show to you guys is called the Link Up 10,000. Essentially, it is generated daily, and it captures the sum total of US job openings from the top 10,000 global employers. So essentially, we're talking about job openings here. And it's significant that we have seen that on the slide over the course of this year, and that has continued and really ramped up of late. So much like the JOLTS job openings figure that has been on the slide, we've seen a similar kind of thing here in terms of the daily link-up figures. In terms of the sort of wider picture for the US jobs market, you can see that that payrolls figure has been trending lower over the course of the past couple of years. Of course, much of that was normalization following some pretty wild swings that we saw around the pandemic. But now we've gotten to a point where payrolls figures are pretty uninspiring, ADP figures pretty uninspiring, and therefore there's a perception that we need to see the Federal Reserve step in to boost the economy, boost the jobs market. There's also a huge amount of sort of upheaval when it comes to immigration and some of the policies enacted by Donald Trump. We've got the AI boom coming in at the same time, and I think that's going to raise unemployment over the medium term. So there are a number of factors in play here. Quite whether a rate cut is going to suddenly appease this situation remains to be seen. But certainly with that dual mandate, there is a focus on perhaps the ADP payrolls, the non-farm payrolls, more so than the unemployment rate, which at 4.4% still remains relatively low by historical standards. So in terms of this release, what are we going to be looking out for? We're looking out for whether we see inflation remaining under control, and that essentially will be the final, not nail in the coffin, because that generally rules something out, but whatever the opposite of nail in the coffin is, it would essentially sign off on the rate cut for next week. In terms of the market impact, if that were to take shape, let's just look here at, there we go. So let's look first and foremost at the likes of the Dow Jones Industrial Average. Now, of course, we've seen a bit of a rebound of late where the bulls are coming back into play. And certainly, I was talking at the time and saying, I get the idea that people are fearful around this collapse in the AI trade, but is that going to happen when we're seeing such strong earnings? Well, no, that's not going to happen. So we've seen this rebound notably coming into play from the 100-day SMA. And you can see we're now getting relatively close to the prior highs. Are you looking at this as a retracement before we start to roll over once again? Well, the way to see that is essentially you want to look at this from a fib perspective and start to see whether we're respecting any of these fibs. Well, we've come into the 76.4 fib, started to roll over. taken out that near-term swing low around about 47372. That is a bit of a warning sign, but it doesn't necessarily mean that we're topping out. And certainly the fact that we're regaining ground at the moment means that we could push towards that 47778 resistance level from the 76.4 Fibonacci once again. And if we do break through that level, it gives you greater confidence that we're ultimately going to head back up into record highs once again. So the bullish trend is very much in play. What you do often see is that trends will see more significant pullbacks into deeper moving averages. That's exactly what we've seen here. We didn't break through that major swing low of 45172. We just saw this sort of wider pullback into play, much like this, right? So you've got that trend, you break through the swing low, but ultimately when you've become relatively extended in one direction, you can pull into that wider retracement. That seems to be what's happened on this occasion. So I still think that we're going to push up into record highs personally, but certainly if we break out through this 76.4 fib, does give me greater confidence that that's exactly what we're about to see. In terms of the US dollar, of course, if we're in a position where we're going to suddenly see a ramping up of rate cuts, that's what's going to point towards potential weakness coming into play here for the US dollar. And all this talk about the successor to Powell being announced soon, it does have people quite excited. And like I said, I think the real major movement in terms of the US dollar will happen when we see that repricing towards where the terminal rate will be, because I don't think that whoever takes the job, in all likeliness, if it's Kevin Hassett, he's going to be pushing for additional rate cuts. He's not just going to say, right, let's keep rates at 3% and just sit on our hands. He's going to be looking for 2%. He's going to be looking for 1.5%. And that is the signal in my mind that we're going to see the US dollar really coming under pressure once again. Because, of course, what we saw here was a sort of period where Trump came into power. We saw this ramping up in terms of euro dollar, weakness in terms of the dollar. And we've been treading water for, months now, right? So that part of the trade is over. I think there is another leg to be had. But it's really a question mark of when we see that repricing around the terminal rate in my mind. Now, that doesn't mean that we can't see significant price action over the near term, because we have that as a background story. And then to add to that, we have near-term price action based around what's happening at the Federal Reserve next week. So as you can see here, we've seen a pullback. Is this a sort of retracement here? Does that signal that we've perhaps come into the end of it? Well, come into the 76.4. We've initially flushed past, but then come back into it again. And crucially, we're now back up at this, what would be a potential sort of neckline here at 11656. So if we break through that resistance level, that points towards, in my mind, another move towards the upside here, and an end to this sort of retracement phase that has been in play here for euro dollar. But certainly if we see weakness in terms of the inflation gauge, greater confidence of rate cuts, and that background knowledge that there's a good chance we're going to start seeing some movement on expectations for the terminal rate next year, that in my mind provides the basis for an additional bout of US dollar weakness going forward. And finally, let's look at gold. It's been an interesting time. We've seen a significant pullback coming into play. Then we've been trying to regain ground from there. You can see here in terms of the 4-hour chart that essentially we've been coming into sort of trendline support time and time again here. And that has worked out perfectly. I mean, look, for those sort of 76.4ers like myself, it's been a very interesting time in terms of the fibs, because time and time again, we've been hitting this 76.4 fib and moving higher. I mean, it's been brilliant. So aside from that, aside from just the fibs, what we can see here is that we've seen that leg higher. We've now broken through that prior swing high, and that means that it sort of takes the pressure off, because in my mind we could even move all the way back down to trendline support, but the bullish case still remains in play, right? As long as we're seeing that regaining of ground to climb that wall that was lost essentially back in the back end of October. Do we see that wider pullback coming into play? Well, potentially. I mean, look, it's quite a difficult one to call. I would just say if we break the 4149, that's when it points towards that move. Now, ultimately, we've come into the 76.4, but we've moved quite swiftly beyond that. that doesn't necessarily scream to me, this is the bottom of this move. We have also then rallied up into your swing high here, which is 42.30, that would give me, if broken, give me the signal that maybe this sort of pullback phase is over and therefore we can start to feel more confident. But we didn't. We came into that level and now we're starting to roll over once again. So risks remain of a deeper pullback here for gold. But from a longer term perspective, I just think that this is by and large a sort of healthy pullback. You know, are we now just going to surge up into 5,000? Probably not. But I think maybe it's a bit more gradual. Maybe we're in some form of consolidation. What's going to be the driver? There could be a number of drivers, but like we're talking about the possible movement in terms of the US dollar weakening and the high likeliness in my mind of that terminal rate moving in a significant way, that could provide a significant driver for gold to move higher once again. So yeah, we're sort of at a phase where, yeah, we could see a rate cut in December, but then we could see 3 meetings of nothing. And therefore, it's not necessarily getting too excited at the moment on the gold front. But I do think we still have further legs in this story. But yeah, until we break through that initial swing high that I just showed to you guys, which is at, so I'm just trying to clear it up after all my fibs. Unless we break the 42.30, then there still remains a risk of a deeper pullback. So a break through that level points towards another push towards the upside. Otherwise, another retracement or another leg within this retracement phase that I think is ultimately all part of a wider story that calls for further upside for gold. I hope that's been useful for you guys. Make sure to like, subscribe, and follow for more content like this. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day and good luck trading.